Hey friends, welcome back to the channel. My name is Sanj and today we're going to try and answer that question around why does the share price of a company drop just on the ex-dividend date? And if you're thinking of buying shares in this company, should you buy just before or just after? Like this drop that happens in the share price, is that like a cool secret discount that no one knows about that you can get in on if you want to buy a particular company? So we're going to try and answer that question, try and understand the mechanics behind what's going on there, and also look at some recent examples of when it happened with companies like FMG on the Australian Stock Exchange. So let's get into it. So to start with, let's look at dividends. What exactly are dividends? Because this whole thing centers around dividends and the dividend date. So dividends are where basically a company has said, we've made a certain profit and we want to give part of that profit towards our shareholders. Now, I think I'll need to do another video on dividends in detail in the future around what's going on, why is it happening, why do some companies pay larger dividends than others? What I would say is it comes down to a couple of things. One is it depends on what stage that company is in its growth cycle, what kind of industry it's in, and also a little bit around the management and also the country that that company is in. Some countries, it's more favorable for the shareholder to receive dividends, like Australia, and in other countries, it's not that much favor, or it's not that great to necessarily get dividends, and it's better to have those proceeds reinvested in the company consistently rather than paying it out as cash to the shareholders. Now, there are some key dates you need to know around dividends. One is the declaration date. This is when they officially say this is the dividend we're going to pay this financial year or for this particular 6 months. Often companies will pay dividends twice a year. They'll have an interim in between and a final dividend for the financial year. And then there's an ex-dividend date. And then there's also the actual payment date, the day the actual dividend is paid into your account. Now, the ex-dividend date is the key date because what this date is, it's the first day where the shares are trading without an associated dividend associated with it. Meaning, if you buy shares on that day and you hold those shares on that day, you won't be getting the dividend. I think the X stands for excluding dividend, but generally it just means no dividend. The other thing to know about dividends is they're often reported or indicated by the company as a dollar per share number. So often a company will say, we're going to pay out a dividend and it's going to be $2 a share or $3 a share or 50 cents a share. And that's quite useful for you because you can then say, okay, if I have 100 shares, if they're paying me $10 a share, that means I'm going to get $1,000. That's really good. I've not seen that happen, but that's a really good return, a really good yield in terms of your dividend. So then we move on to the question around why does the share price drop when you hit that ex-dividend date? What's going on there? So to answer that question, we need to first look at what does the share price actually reflect. The share price reflects the value of the company when taking into account future cash flows that may come into play. And if we're expecting good things for the company compared to where it is today, it'll have, a share price that's going to continue to grow. If we're not expecting much from the company, the share price you'll start to notice will start to go down over time because people don't see as much value in that company in terms of its future cash flows. And the dividend, it's not coming from somewhere magical. It's coming from that company. And so it's coming from the total value of that share price. So you can sort of see the maths come into play here. The share price reflects the total value of the company per share, and the dividend reflects what's going to be paid to you as a shareholder per share, represented at that level of unit. So then you can see when a company pays a dividend, it makes sense for the share price to drop because the shares are worth this much. And if you buy shares before the ex-dividend date, before the date when it no longer includes a dividend, you're going to get that dividend. Then the day of the ex-dividend, you're no longer getting access to that dividend, and so the share price should drop equal to the amount of the dividend payment, theoretically speaking. So as an example, here's a situation where a share in a company is $10 a share. You can see it's sitting flat around there. The ex-dividend date is the first marker. The dividend that's been dictated here is $2 a share. So the company has said, we're going to pay you $2 a share in terms of dividends. And you can see when it hits the ex-dividend date, the share price goes from $10 down to $8 because $2 a share of cash is going to go out the door. And if you buy that share on the ex-dividend date, you're no longer going to get access to it. So naturally, it makes sense that that share is now worth $2 less. That's theoretically what should happen. It should go along at a certain value, drops, and then it keeps going. So let's now look at a real life example from the Australian Stock Exchange, something that actually happened just a couple of months ago. So we've got FMG, which is a large iron ore mining company based mainly in Western Australia actually, and they were running, their share price was sitting around $20, and on the 30th of August, they said they're going to pay out a dividend of $2.11 a share. So $2.11 a share, they made that very public, very obvious. And they said the ex-dividend date was going to be the 6th of September, 2021. So that's the first day with which, if you own shares on that day, you will not get the dividend. But if you own shares the day before that, any day before that, any business day before that, so remember Saturdays and Sundays don't count. If you own shares any business day before that, then you will get access to that dividend. You'll get access to that dividend payout. And so here's a graph of FMG's share price, and you can see the big D, that is where the dividend ex-dividend date was. And you can see in the days coming up to it, it was $20.71, $20.85, and then bang, when the dividend ex-dividend date hit, it dropped to $18.57. And that kind of aligns with the fact that the dividend was going to be, or was, $2.11. So it dropped by about $2, because now the share price, before the ex-dividend date, the share price reflected someone who was going to get access to the dividend payment. Then the next day, when it became ex-dividend date, the share price reflects the shares minus the dividend payment, drops by about $2. So it's sitting at $18.57, then it dropped down to $17.99, $18, and then it's actually continued to slide down. Now, FMG, someone in the audience, some of you might say, not the best example, Sanji, because FMG had some underlying issues as well. And that's probably where I'll throw up this quick graph where I'll show, ideally, what generally happens on the first day when it's ex-dividend, the share price does drop, and it should reflect that immediate impact of the company is no longer paying that dividend to you if you own shares on the ex-dividend date. What then tends to happen is two things, naturally speaking. Well, three things. One is then the share price will continue to kind of slide along at that new lower price. Other times it might then start to drop down, and that's what happened with FMG, and I'll explain that a little bit later. And other times after that, you'll see the share price will then actually start to recover and go beyond where it was after the ex-dividend as well. So there's a couple of things going on. Where it just keeps going along, that just means the company no longer a dividend associated with it, and the market doesn't see not much changing with the company after that. If the share price starts to slide down, that can be an indication that some of the fundamentals associated with the company have started to deteriorate as well. Now, this could have been a trend that was already occurring. So you sort of saw the share price was going down, and then there's a drop, and then it keeps going down even more. And that's because there was a dividend moment. And even if the dividend wasn't getting paid out, the company would still be going down. And that's sort of what happened with FMG, and I'll throw up this graph, where the blue line represents FMG's share price, and the orange line represents the iron ore price. And remember, FMG is a pure player iron ore company. And as I've said in previous videos, when a mining company is a single commodity miner, its share price really just reflects the underlying price of the commodity, because that's all you're doing. Basically, you make one thing, you pay the market, you get the market rates for it, so naturally your share price is going to go up and down with the price of the commodity. And that's what you saw with FMG is in August, when the iron ore price started to go down on a bit of a dip, and I'll let other players out on the internet tell you why that happened. Someone's probably going to say something about China, but it did start to go down from record highs. And you can see the blue line then start to track it down as well, because everyone thought, well, if the iron ore price is going down, then obviously FMG is going to make less money next year. So I should probably, I shouldn't expect as much from it. So the share price started to go down. And then you can see when the actual date of the ex-dividend happened, there was a dip, but it just kept going down. So this is a classic case of, well, the ex-dividend date happened in the middle of a sell-off anyway, so you saw the drop, but it kept going. So then we come back to the original question of what's going on there, why did it happen? Hopefully you can answer that. It's basically reflecting the share price now without the dividend associated with it, so it makes sense that the share price drops, and it should drop by the amount equal to the dividend payment, or the expected dividend payment. Now, should you buy before or after? Is this a secret discount that no one knows of and you can get in on? As you can tell, it's not a secret at all. It's very obvious, and it's really up to you whether if you buy it before the ex-dividend date, you're going to get the dividend payment. But if you buy it after the ex-dividend date, yes, you'll get it for less than it was before, but that's because you're not getting the dividend payment. So you're getting less value, so naturally the share price is worth less. So one thing to be conscious of is how much does the share price drop by? If it drops by equal to dividend amount, that makes sense. If it drops by less than the dividend amount, that's interesting. There's obviously a lot of positivity reflected on the company maybe. Everyone's really expecting great things. If it drops by more than the dividend amount and it continues to drop, that's a bit of a concern. You should look out for that. What are some of the underlying factors that are changing with this company? So that's it for today. Please do check out my Instagram page where I go into a little bit more detail on various topics, and also consider subscribing to my mailing list. And I'll see you in the next video. Bye for now.